Okay, testing, 1, 2, 3, testing, 1, 2, 3. The Wayne in Spain falls mainly on the plains. The Ants in France stay mainly in your ponds. How are we doing over there? Okay, there's YouTube people. There's also links to the chat room on FX Street. Cool, so I guess we're here. Ramon and Henley and FXS video say hola. Welcome to Trade Non-Farm Payrolls Live number 141. 141 months in a row I've been doing this webinar. So we're coming up to the 12-year anniversary pretty soon. How nice is that? Let's start with the disclaimer. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, however, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So we got the big jobs report. Where are we sitting in the United States of America? Well, we're sitting at near full employment, right? Near full employment or natural levels of unemployment. That includes frictional and cyclical, right? But not structural. Nice. So this is non-farm payrolls. There isn't actually a non-farm payrolls economic release by the government, by the Bureau of Labor Statistics. It's actually the Employment Situation Report, which takes a look at non-farm employment. Because if you look at the history, there was a time when 2/3 of the U.S. was agricultural based. And so they wanted to look at really sort of the factories and see what they were doing. Well, now 70% of the economy or more is non-farm payroll. So what happens is the Bureau of Labor Statistics sends people up and they look at two different parts of the economy, gather information two different ways using two different methodologies, and then put that together with math and fuzzy logic and try to extrapolate what's happening nationally. So the first thing that happens is, maybe not the first thing, but one thing that happens is called the household survey. And that's where someone goes door to door to door or phone to phone to phone and asks you questions like, hey, do you have a job? Are you even looking for a job? That kind of stuff, right? But they're not asking you, do you have a good job? Do you have a part-time job versus a full-time job? You know, because that answers the question, you know, are you fully employed? Are you partially employed or underemployed? Right? So that's the household survey. You know, they're surveying people. On the other side is the establishment survey, where they're surveying the company. And this is where they look at the payroll stubs. Sort of like your ADP report that came out yesterday, typically on a Wednesday. They're looking at stubs, you know, pay from your boss paying you. So they count those. Okay? So anyways, so they take this information because they're clearly not surveying the entire United States of America. Every one of the 380 million people living here, right? Or what's the workforce? The workforce isn't 380 million. This is probably 250 million. Something. But anyways, obviously they're not surveying everybody, so they take a sample and then math. And the math whizzes come in and they make up a number. And apparently they've been able to do that in the last 4 days with extreme accuracy. So clearly there's room for error, and that's why we look at things like revisions, because then they have a whole extra month to do more surveys and get better data and then come up with a better number. Cool. So that's non-farm payrolls. Glad you're here. No, it's not in here, and I was thinking of it right before we started. I don't have a slide in here to introduce myself. I apologize. My name is Wayne McDonell. I am the Chief FX Market Strategist for Traders Way. We're a small boutique global trading firm. We have fast execution speed, competitive spreads, world-class customer service, and I work with our clients every single day to help them work on their technical and fundamental analysis. So swing on by tradersway.com, open up a demo account, takes literally seconds. Then once you're in the back office, you'll have this opportunity when you open up your account, you can choose between a fixed spread, a variable spread, or an ECN. So ECNs basically don't have spreads, or micro spreads. The fixed spread is interesting if you're a scalper. The reason I say that is if you're scalping, high volatility event-driven scenarios like non-farm payrolls, like retail sales, and all that kind of stuff. If you're trading the vol or volatility, sometimes the spread can go much higher than normal, and that's not necessarily the broker. It's definitely not Traders Way, right? What happens is when Traders Way enters the market into the intermarket, those are high risk events, and spreads in the intermarket jump. Okay? So anyways, if you're a scalper, you don't want to trade Euro USD and find out for 5 seconds the spread jumps to 12 pips or something, and that 5 second window is right when you decided to scalp, right? When the market is risky. So anyways, if you have a fixed spread, well, then you always know it's going to be 3. If you have a variable spread, you're probably picking up 1.1 or something like that on the typical situation, but it might go a lot higher than that. Not significantly higher, but a bit higher than the fixed spread around those big event-driven stuff. And then, of course, if you're doing ECN, well, there's no spread anyways. All right, so it's your way at Traders Way with Trader Wayne. So anyways, that's me. This is the 12th year, right? So we're coming up to the 12th anniversary of this webinar that I've been hosting with FX Street, just 12 years. So I've been trading Forex a while, obviously longer than 12 years. The funny thing is, if you're fairly new to Forex, imagine this. When I opened up my first trading account, they didn't accept credit cards. You had to wire. I think the minimum deposit was $5,000. Now brokers accept $5, right? So $5,000, you couldn't, it wasn't easy. You couldn't just, and in America, we're not used to wiring stuff. I know around the rest of the world, wire money all the time. America, wire, what's a wire? You got to go to the bank for crying out loud. So anyway, so you had to wire it, and that got you a trading account with lots of flickering buttons. Bleep, bleep, green, red, green, red, green, red. And you're like, wow, what does that mean? No charts. My first trading account had no charts. So I had to pay something like $150 or $200 a month to have charts. Isn't that interesting? I went to this little startup website called Amazon, and I did a search for Forex, and there was one book called Forex Made Easy. That one book. Like, this is what the world was like when I first started trading. So I went to Barnes & Noble to look for books and got myself a coffee. And the only book they had was Forex Made Easy. So I had to go to the Stanford University's bookstore, and I went to the economics section, and I tried to find textbooks that would teach me something about Forex. Isn't that interesting? Several years later, I started posting videos on YouTube, and for a while there, if you typed in Forex, I was the first 12 pages of video results. So back then, even a bajillion years ago, I had several hundred YouTube videos, and so if you typed in Forex, all my videos were the results. So it's just sort of like a flashback how long I've been trading Forex. If you say, oh man, I've been doing this for 15 years or so, when you put it in the perspective of, that's longer than YouTube, It's amazing what the world was like, huh? No YouTube. How could you have children if you don't have YouTube? So anyways, good to see it. So non-farm payrolls, the employment situation report. We're at full employment anyways. Full employment being the natural rate of unemployment, as I discussed earlier, where we have frictional, and we have cyclical, but we have no structural unemployment. Okay, so that's where we are. So the question now is, how about wages, right? And we're still waiting for wages, because then wages leads to consumption through the marginal propensity to consume, which is quite high in the United States. So the more that a worker earns, the more they spend, the more that consumption goes up, the more that GDP goes up, and GDP is a measure of production. And then at some point, prices will go up. It moves the equilibrium around and all that kind of stuff. So that's what we're talking about today. I'm looking at the chat here. Yeah. Yeah, Ryan says my first stuff I used to do with FX Street was it was text chat. There were basically interviews, and we would chat back and forth with the moderator. It was interesting, but I was doing something radical at the time though. I was using webinar software to broadcast my charts live, and very, 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 very few people were doing that at the time. I was one of the first. I think at the time Ed Ponzi was doing that with FX Street too, about that same time, through, I think he was using Hotcom. So it goes all the way back to like even just what we're doing now was very, very, very unique. A webinar wasn't the term at the time, but what would happen is you might have a camera like this, and you might have a PowerPoint like this, and that's all it was. And it would change the deck. When you pressed a button, it would change, but it wasn't broadcasting. It was just, you had to upload the slides, right? So it wasn't a true broadcast. But then there was some new leading software, Hotcom was one at the time, that would actually allow you to broadcast your desktop. And I said, well, if I can broadcast my desktop, I should probably broadcast my charts. And if I traded with my charts live in front of people, maybe I can develop a community. So that's how FX Bootcamp came about a million years ago. Neat, right? All right. So anyways, take a screenshot of this so that you have the basic setup for the charts. Okay? So that you don't come back and say, Wayne, what's that line? I'll say, dude, the green line's 200. You can see it's slow. It's above everything else. That's the 200 EMA. Okay? So you can take a screenshot. 5, 4, 3, 2. Those are the hardest ones, right? 1. All right. So let's go through this. I thought I fixed these. I didn't, huh? All right, let's go through this. That's the combination of the 21 and 55. You know what? Let me just fix it now. Well, let me squeeze the agenda in. How rude of me. I need to take cotillion classes. So in the first bit, I will go over the general sort of methodology. That's what we're doing now. And then we could kind of prep for non-farm payrolls. Then the actual event will occur, and we'll take a look at that and try to hold your hand through the volatility. And that will then get us, you know, let's say through the first hour, hour and a half. And then we'll have another hour and a half where I can just answer questions about technical analysis, fundamental analysis, trader psychology, starting a fund, managing a portfolio, so anything that you want to talk about. The way I look at it is you're the boss and I'm just a humble currency analyst that's been around for a while. Okay? All right, so let's go back to this. The speed, the momentum, the trend, volatility, oscillation, and stochastics. I'll go through how I develop my charts. And I've been trading with this setup forever. Okay? And then overlapping pivot points. I was one of the first guys to ever use pivot points. I remember speaking at the FXCM Traders Expo, or FXCM Expo. I think that was like 2005. And I did a big presentation on pivot points, and everyone, freaked out. It was great. The room was so packed that the fire marshal came in, right? And had tried to clear the room and stuff. It was that packed. People were sitting on the floors in between the rows and behind the projector, leaning like this, trying to see what was going on. And at the end of it, I was told that FXCM's trading platform didn't offer pivot points. I'm like, not my problem. But, like literally nothing's changed. Amazing, right? Nothing's changed. So I think that's good. I've never released a new cool trading method. I have a cool new trading strategy, and it's got a cool new name, and you can buy it from me. I've never had that. So this is what I've been doing forever. I just want you to know that. And then the next thing is, well, why do you use these? Why do you use these moving averages, right? Don't you want to know that? And it took blood, sweat, and tears for years to get to this point. And I started to find success when I stopped following indicators and I started using indicators to gather intelligence for me so that I could formulate a strategy for the market. It was different. It was reverse, right? So when you first start, you're very mechanical, and you're like, oh, is the 21 above the 55? If it crosses, sell. If it crosses, buy, or something, right? And then, so the next phase is you use the indicators to get the information you need. So you're looking at the market, and you want to discern, what is the market doing right now? What are the market conditions? Is it bullish? Is it bearish? Is it aggressive? Is it slow? Is it neutral? But you're asking different questions. You're not saying, what does the MACD tell me? Right? Anthony says, I'm an old bootcamp. And you have not changed. It's funny, now that you say it that way, Anthony, then I'm like, really? Now it sounds insulting, right? Like, golly, that's true. I haven't changed in 15 years of teaching people Forex, right? Like, wow, is that good? Or all I know is I get better looking every day, I get smarter every day, and I get more and more modest. It's awesome. But anyways, it's nice to know but maybe, just maybe this methodology could work for you too. That's all. And maybe you could be a lot better of a trader than me in a lot less time. And that's probably true. If you think about, I must have done it the worst way ever, like smashing your head against a brick wall, right? Eventually I got through the brick wall. At least you don't have to start with nothing, right? I didn't trade stocks or futures or anything before that. I was a venture capitalist, so it wasn't even in my nature. And the very first stock I ever bought was Apple Computer, and I paid $6 a share. And I sold it just after Steve Jobs died. So, I think the last stock I bought speculatively was Bank of America at $5. Right? And that one I told everyone about well in advance and all that kind of stuff. So, whatever. All right, so let's go back to this. 2155. Well, the question I was asking when I put these charts or these moving averages is, I want to know if the market was bullish or bearish, and I want to know how bullish or how bearish. For example, is it moving quickly or is it moving slowly? So that's why I call it speed. If I go back to here, and this is right out of my book from 8, 9, 10 years ago, wherever it was. Speed. I use the 2155 EMAs to measure the direction and speed of the market. Well, that begs the question, well, what's the market? And I say, well, great question. I define the market as something like this. A friend of yours, maybe your spouse, if you like your spouse, you're friendly with your spouse from time to time, and your spouse says, hey, so how'd the markets go today? And you say they were down. It's a pretty broad question, right? Now, if you actually are a trader, you're like, well, it was down for 3 hours, then it rallied back for 2.5 until it got to a fib ratio, then I dumped the sucker and sold it back down and it rallied back down, but then it double bottomed, so I was looking for the 1, 2, 3, and then, wow. But to someone not a trader, they're just like, hey man, so how were the markets today? They were down. That's all I'm asking here. But, well, that's not true. Okay, I'm asking, are they up or down? And is it falling? In this case, it's down, right? Is it falling quickly? Or is it not falling quickly? Because that tells me, should I be aggressive or should I be conservative? Okay? I hope that makes sense. Because then it helps me set up the trade, right? So in this case, the 21 is below the 55. And let's just call this a trading day. This is 7, 8, well, this is actually a trading week, right? But anyways, it started the week bearish, right? It was very aggressive on Monday and started to slow down Tuesday, Wednesday, Thursday, Friday, okay? So I look at not just, the 21 is below the 55, which tells me I'm bearish, technically speaking, right? Now, we can argue fundamentally all you want about, oh, wow, okay, fine, great. But looking at this chart, looking at this time frame, looks like it's an hour chart. This is technically bearish. You can argue some other way fundamentally, or sentiment, or whatever you use. But I'm like, dude, 21's below the 55. I don't care what your opinion is, but technically speaking, right here, right now, at that moment, it was bearish and it was aggressive. And then you'll notice the diminishing distance between these two lines. See, they were expanding, and then right around here they start to contract. That tells me something. It's still bearish, but it's a lot less bearish. Okay? The other thing in my language or vernacular, you'll hear, I'll say things like the 21's in control. That means I'm bearish and aggressive, and I'm looking to sell, and I'm looking to sell hard. Once we breach the 21 and the 55's in control, I'm looking for double bottoms now, ahead of time. So even right here, I'd say there's a high propensity for this to bottom out. I'm bearish, but I'm very conservative. In fact, I'm expecting a reversal soon. And that's usually when psychological levels come into play. That's usually when pivot points come into play. But we don't have that on the chart right now. Okay? So the actual pulling of the trigger occurs with the 5 and the 8 crossing. These are the 5 and the 8s, right? Going back to this. Now momentum. Okay? So you'll see when this chart started, looks like Monday morning, we were already bearish, which means it was bearish last week. So if you think about it, this chart probably repeated something or preceded with something pretty similar. It ended the week already bearish, as you can see here. So you could have started Sunday or Monday morning, you're like, I'm a bear on this, so I'm looking for a reason to sell. Well, this would be the reason, the 5-8 cross. The cool thing about it is the 5-8 crossing back up is your reason to take profit. If you only use these moving averages, you never took profit. In fact, you're still short. Moving sideways, but you would have shorted earlier, right? Here it says short, take profit, and then braid, 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 braid. When that happens, you try not to trade. You might have shorted here, okay? Now if you shorted here, you see you got a good entry. Didn't last very long, but you knew that. Going back to the 55, you expected the drop to be shallow, making you vulnerable to reversals, okay? But you knew that when you pulled the trigger. How cool is that? So this tells you to sell. okay? And this tells you to take profit. You see all this braiding? Oops. How do you know not to like sell that 5A cross down or sell that 5A cross down or sell that 5A cross down? Well, the reason is you're not at resistance. That's what the 21 is. You wouldn't sell here, you wouldn't sell here, you wouldn't sell here, you wouldn't sell here. Maybe here, but it wouldn't have lasted very long, okay? Okay, 200 EMA is trend. In my book, I discuss it as the fair market value. This is the price in which bulls and bears agree. So you're not there very often, right? But when you're there, at least in my humble opinion, the market is neutral. And I don't care how bullish you are or how bearish you are. If you trade when you're at the 200 EMA, it's 50-50. You don't know if the bulls are going to take over, if the bears are going to take over. It's kind of a reset. It's a timeout. Okay, so I tend to be very conservative and neutral when I'm there. If price is too far away from the 200, it tends to retrace back to the 200. So I often say 200 is a target if you're counter trend trading, but it's not an entry when you're at the 200. Okay? The 200 EMA is a target, but not an entry. Okay? Bollinger Bands I use as a volatility indicator. And you can see in here there's no volatility whatsoever. When the bands are wide, there's lots of volatility, lots and lots of trading. You could even say it's volume. Now I know it's not using volume, but you can't have volatility without volume, right? So you can see here like lots of people are trading, and then all of a sudden the Bollinger Bands narrow to like a tight tunnel. That means nobody on the planet is trading. Nobody on the planet is trading. So if you're trading, you're on your own, and you're probably not that big. Hey Fred, how you doing? And so there's a chart. But what I'm looking at now, because that's the same chart, what I'm looking at now are the oscillators. Now this is cool. It took me a while to figure this out. The reason is I didn't know what a MACD actually did. And I'd guess most people here, even if they use MACD every day, don't really know what MACD does. So it turns out it's a moving average convergence divergence indicator. And what I wanted to know is this. I found it pretty difficult. Like, I know the 21 is below the 55, but at what point are they not expanding? At what point are they contracting? Okay? Convergence means moving together. Divergence means pulling apart, like here, of moving averages. The moving average convergence divergence indicator. That's all it is. So when you throw down a MACD on your chart, it comes out weird, right? Like, what is it, 12, 16 or something like, it's a weird setup. I don't know who uses MACD like that. I guess a lot of people, right? But so like if I oh, well, I don't think I even have a regular MACD on this chart. Anyways, when you add it straight out of the box, oops. When you add it straight out of the box, it measures two moving averages that I don't know if anyone uses, right? So what I did is, this is the 21.55, and I simply wanted to know, when is it diverging, which means I'm bullish, or I should say aggressive, not necessarily bullish, it could be aggressively bearish. Or when they're converging, I should be a lot less bullish or a lot less bearish. Not necessarily reverse, but I should go from aggressive to conservative. Okay? And I realized, oh, there's an indicator for that called the MACD. So I plug in the 21.55 and I measure it over 8 periods. Okay? And this is when the 21 is pulling away from the 55. And this is when the 21 is moving towards the 55. But as long as we're below this histogram, the 21 is still below the 55. So this could be rising. Doesn't mean I'm a bull. It means I'm a conservative bear. Isn't that cool? So it gives me the overbought and oversold conditions for the market. Remember, that's what this is measuring. The market. Hey, what's the market doing? Well, the market is bearish, but there's some profit taking according to my MACD indicator. So I'm conservative. That's really what it's telling. And then the oscillator down here is the stochastic. And all it's doing is looking at the high and low of the previous candles. Okay? And that's giving me overbought and oversold conditions for price. Okay? So this 5A cross is representing price, where the 21.55 is market. See, market forces and price action, the market and price. And what led me down this path is this simple thing is when somebody said, what are the markets like? They want to know if it was bullish or bearish. All right, the markets are down today. But when you sit there minute by minute for hours and hours and hours and hours and hours and hours and hours, you know that even in a bearish market, price rises. There's lots of green candles in a down market. Well, there's more red, but there are lots of green. And I realized, well, there's two things going on. They're asking me about the market, but I tend to be trading the price, right? There's the market, and then there's price. I'm like, wow, I should do something to discern the two, because when the market is falling, I should be a seller. Sounds easy, but you're not doing it. So that's where I hope to take you. That's the journey there. Okay? Throw on support and resistance for the market as well as support and resistance as price. Because like if I connect these candles or something, or these wicks, and I say that's support, okay, that's one way to design support. That's support of price, because I'm looking at the price, what happened recently, and I create a support and resistance zone. I can also use support and resistance of the market. And that's what pivot points are. They look at the high, low, and close of the previous market, and then they try to predict the current market. Before, it's a leading indicator, whereas everything else is a lagging indicator. So I take all this information, and then I use a leading indicator, and that's pivot points. And that's the whole kit and caboodle. And then you have to do that on multiple time frames, and then know everything on the planet. You need to know election cycles, you need to know central banking policies, you need to know inflation levels, you need to know major imports and exports for every country on earth, and you got to pay attention to weather and geopolitical risk and natural disasters and all that kind of stuff. Right? So I like when people ask me what I do and I tell them, and they're like, wow, that sounds difficult. And I'm like, no, not really. You just have to know everything and accurately predict the future every single day. How hard could that be? Then I say, so what do you do? I work in a cube in the marketing department. I make PowerPoint presentations for my boss. Nice. Oh, so MACD typically 12, 26, 9. Yeah, all right, so there's good. Is anyone here like seriously trading because of what the 12 and 26 moving averages are doing over the last 9 periods? And for me, the answer was no. So I'm like, why would I use MACD on those settings? So, you know, I feel like I should call Gerald Appel, the guy that invented the thing, and say, hey, Jerry, what's the deal with the 1226, bro? I mean, seriously. The way I got to 2155 is when I first started, I used the 2060. I just messed around with moving averages until I found two that seemed to work well for me. It was 2060. Okay, not the 50-100. It just this worked better for me. 2060. And I used that for a couple of years. Found pretty decent success, enough to quit my job as a VC. I'd just been promoted vice president of the firm. We had 300 employees. I had a job I loved to do, but I quit to do Forex. Right. And so anyways, 2060 worked great for me. And then one day I was meditating, because I meditate every morning. Been doing that for about 20 years. So anyways, I'm meditating. And I get naked when I meditate. I don't know about you, so I'm sitting there naked. And I'm pondering, why does the 2060 work? Why does the 2060 work? And then I said, Fibonacci. 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, right? And I'm like, whoa, 20, I use 2060 and 2155 are fib numbers in the Fibonacci sequence. And I'm like, that might be it. So I rushed to the computer, still naked, and I changed my 20 to 21. You know what happened? Like basically nothing. Like no difference. I'm like, okay, cool. And then I changed the 60 to 55, and it went from here to here. Like a small difference, but not a significant difference. And I'm like, huh, well maybe that's why it works. Right? Gagzoos. So that's how it came across. Now, I'm open and honest with people. I don't think it has anything to do with Fibonacci, but who cares? Just another reason to, like, maybe drink my own Kool-Aid. I'm okay with it. It confirms my bias. Okay. So, what is the time? The time is... All right, we got 20 minutes until the newsies. Whoa. I'm going to do this now. All right. Let me get... Yeah, GM says, so Leonardo Fibonacci was a trader? Yeah. Yeah, he totally was. He traded wine and goat meat futures, but that's fine. Okay. Hang on. All right, so I guess we can go into this, and then we'll have some time in the news. So just, I guess what I was saying earlier is it doesn't really matter what the headline number is going to be, because the Fed is already locked into a policy. All right, they're not going to change the policy, and that maybe is an important thing to touch on. As traders, you can scalp the news, but you're not trading fundamentals. All right, you're a volatility trader. So when I say, pay attention to the fundamentals, what I don't mean is like, what's the headline number on NFP? If you care about that and you're trading it, you're a scalper, which is fine, right? All the power to you. But you're not trading fundamentals, you're trading news events. And those news events, especially if they're unexpected, can create volatility. Okay? So you're just a vol trader, which is great. Scalper. Fine. So NFP will come out, it'll move. It'll probably move 50, 60 pips quick and then stop. Great. We can pick up a few pips. It's not going to make or break your career. On the fundamental side, it doesn't really matter, I think, what's going to happen, because it's very, very, very unlikely the number is going to be horrible. And it's very, 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 very unlikely that the number is going to be amazing. It's probably going to be within 2 standard deviations of average. Right? Cool. So what does matter? And it's really the wage growth, because that's a precursor, as I said before, based on the marginal propensity to consume formula. That's going to increase consumption. Increase in consumption is going to increase both CPI and GDP. CPI being a measure of price, and GDP a measure of production. Okay, so that's really what we're looking for, and maybe revisions. But even then, like a big revision one way or the other is not going to change policy at the Fed. And now, as a fundamentalist, as a fundamental analyst, what I care about is a change in policy at the Fed. Okay? So right now we're cautiously raising, cautiously normalizing. Fine. We got a new Fed chair coming in soon that may or may not change things. Those are fundamental questions. How will the central bank of the economy nurse us off extraordinary measures, which created, by the way, the stock market rally, Dow over 25,000. That's all the Fed. You better thank the Fed. It wasn't Obama's government. All right. So So how are they going to deal with that overabundance of easy money? Because that's what happens as the prices go up. And then, and then the employment being full and wages going up can lead to inflation. And their other mandate, besides a healthy economy, is to deal with inflation. So we're at that point where their decisions are more and more difficult. And with a new body coming in, because not only is Janet Yellen retiring, there's I think someone on the board of governors, the BOG, right? One of the BOGs is stepping down. I think 2 or 3 different FOMC voting members are changing. There's a lot going on at the FOMC. Okay. I was there recently, by the way. Yeah, I went to the Board of Governors building, Washington, D.C. If you're ever in Washington, D.C., and you're looking at the Vietnam Memorial, it's right across the street. So you see Lincoln, then you go over the Vietnam Memorial, and then you walk across the street and see the Board of Governors. Just FYI. So here's event-driven, right? High volatility strategy. AKA, here's the scalp on the news. We're going to let the news come out. I don't care what the number is, doesn't matter to me. Because I'll have time to do the fundamental analysis later. And like I said, fundamentally, no matter what happens, it's probably not that important on a fundamental scale. Now, it could create volatility, especially if it's unexpected. Now, the Japanese yen's been weak. Okay, so let me tell you a secret. Shh, shh. Don't speak. Just listen. The yen might get strong. Today, tomorrow, but very, very soon. And if it doesn't, it doesn't. Don't worry about it. But I have a feeling. I have the feeling the Japanese yen could get strong. And so, I don't know, whatever happens today might bring the stock market down. I don't know. I'm not saying it will, and it's all conjecture. Okay? But if the stock market spikes up even further, breaks, gets to 21,500 or 25,500 or whatever it is, and then profit taking, I think is really what it is. Massive profit taking. that could create some yen strength. Not just for a day, but like for a month or 2 or 3. Maybe. It's happened in the past. It happened last year, and the year before, and the year before, and the year before, and the year before, and the year before that. Do you guys remember December 12th, 2016, I did a 1-hour FX Street interview? It was supposed to be 4 people. The other 3 people canceled because they were too busy or something. But I was in business meetings with central banks in the Caribbean. I had a 3-piece suit on my way to a meeting, but sat down for an hour and did a 1-hour interview. Apparently those people are more busy than I was, even though I was in the Caribbean wearing a 3-piece. Have you ever worn a 3-piece wool suit in the Caribbean? Yeah. So anyways, I wasn't too busy because I love FX Street. I never let FX Street down. So anyways, I did an interview there, and the yens were weak for months. And I said, yeah, I'm about to cash out of all those, Japanese yen pair longs, because I think the Japanese yen is going to get ripper strong. So I'm going to bail. It could be today, it could be later in the week, it could be the first week of January. I don't really know yet, but I'm preparing right here and right now to dump that whole portfolio, take a huge profit, and then I'm going to reverse and I'm going to go the other way. And guess what? Literally the same day, the yens topped out and the Japanese yen strengthened and the yen pairs fell for 4 months. So I'm just saying, maybe the same thing happens this year. I don't know, but I want to be aware. Because, the Dow breaking 25,000, people are now just drinking Kool-Aid. Give me the Kool-Aid. What's in this Kool-Aid? It doesn't matter. Right? Drink the Kool-Aid. That's usually when the thing drops. Because the smart money is selling their positions to the idiots. Right? It's been going on forever. Isn't that how the markets work? So now it's all frothy. Smart people dump their positions onto the frothy market, and then all these idiots that bought high, they get wiped out. Good. Makes me happy. I love that. That's what you get if you're lazy. That's what you get. It's my job. Get those guys out of the market anyways, right? That's my bread and butter. If you don't have a plan, if you don't prepare, if you don't know what you're doing, if you're throwing money at a big frothy market, then good. I'm going to crush you. That's my job, right? I'm a wolf. Ow! So anyways, I don't know. Just stay open-minded. I know you probably made a lot of money on these yens. Just, I don't know, just look for tops, look for reversals. Don't be so confident. I think as a trader, you should always be one step ahead and you don't trust anybody. Okay? All right, so how much time do we got? All right, tons of time. All right, so whatever. We're going to get some volatility when the number comes out. I don't know what the number is. Don't even really care. Great. Boom, boom, boom. So in this case, in this example, let's pretend this is a 1-minute chart, because we'll look at, I guess we can do pound dollar or euro dollar, depending on whether the dollar is weak or strong. I think if the dollar's weak, we'll look at euro dollar. If the dollar's strong, we'll look at pound dollar. Okay? Great. So anyways, the market comes out. And in this case, as soon as the news comes out, there's some volatility, then green, 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 green. All that tells us in this high volatility event-driven strategy is we want to be a bull. Okay? It just helps us make the decision. And then once we made that decision, as a bull, you don't want to buy high, you want to buy low. So if you're a bull, you buy red candles, not green candles. Okay? And so what we want to do is look at previous support and resistance. We want to look at psych levels, and we want to look at fib levels. Okay? Something like this. This is typically where I would buy. Remember, they're 1-minute charts, right? This could happen in 2 seconds. It could be down here and then stop. Okay? So typically, I would want to buy somewhere in here because I'm looking left. It used to be resistance, now it's support. It's a 50% and then 618 Fibonacci retracement. And if I did buy here I'd put my stop loss just below the pre-news low. So in this case, it's basically my stop is just below 48.50, and I went long at 48.71 or 75, let's say. So like it's a whopping 25 pips. So let's say if you lose more than 50 pips or even 30 pips, you're not listening to me and you deserve it. But in this scenario like this, you shouldn't be risking much more than that. Jay says, how many times are you going to talk about the Caribbean interview? It comes up at least once a week. Oh, does it bother you, Jay? Yeah, it bothers Jay. Jay's like, Wayne's bragging about being in the Caribbean. Well, how about this? My business associate and I, who do business in the Caribbean, received Christmas blessings from one of the premiers of one of the countries. So I can brag about that instead, Jay. Sorry to bother you. All right, so anyways. Big old retracement here. I would want to buy. I want to put a stop, and I don't want to risk a lot, right? That's all, right? And you don't want to risk a lot because it's just a high volatility event-driven strategy. It's nothing. It's just don't make a big deal of it, right? This isn't the basis of your career. It's a small trade. It's a scalp, for crying out loud. In this case, it fell a bit further, so if someone was a little more patient, you can see if I bought down at the 618, it jumped quite a bit and then collapsed again. But I'm still fine because my stop's down here. Now, if someone a little more patient, or someone that just didn't have their finger on the trigger, well, now they can buy down here because, look, you can see the 786 held once, twice, 3 times, 4 times. And you end up getting in at the same price anyways, roughly, and your stop's down here, so you're risking 20 instead of 25. It's not that big of a deal. But the thing is, based on what happened, you have rules of engagement. You know you're a bull, and you know you can only buy. Now, the reason I have this line in the sand is this is what's going to make or break this trade. If you can bust through this, you're going to be profitable. And if it reverses, it'll probably reverse because of this line. Because remember, it spiked up and hit that price, whatever the price was. It looks like a psychological price here, right? Hit 149 or something. But the thing is, there's something there, in particular orders, that stopped the market in its feet, in its tracks. So that could play a part in the near future. Okay? So once you got your stop at break even, let it run. When you get into this situation, when you're getting ready, you know, in this case, it's just 3 or 4 or 5 minutes later, it's getting ready to attack the line, move your stop to break even so you have no risk. Okay? Cool. Now, John says, I'm continuing to short Japanese yen and shorting dollar. Well, yeah, shorting dollar for sure, great. And the yen, yeah, which is good. I made a lot of yen, a lot of pips on selling yen last month. I'm not telling you to start buying it. I'm telling you to be prepared for that yen weakness to stop. And it's a seasonality play. Okay? So I'm just saying, be open-minded. Don't drink the Kool-Aid to feel like this is going to last for the next 6 months. Maybe it does, but in the past, this time of year, like literally this week, or let's say next week, right? Monday, Tuesday, Wednesday, Thursday, Friday. For many years in the past, next week is the week when the yen pairs collapse on themselves because everyone is short Japanese yen, which means the yen pair is going up. When it comes down, it collapses faster because everyone's got their stops jammed. So it cascades and snowballs. So you can walk away and all of a sudden your Japanese yen pair fell 300 pips in a day. And it might have taken you a week to make the 300 pips, right? So I'm just saying, just be open-minded and cautious. And as it's falling, maybe you don't just like buy the yen pairs more, like, oh, look at the Aussie yen falling, I should buy more Aussie yen, buy more Aussie yen. But really what's happened is a full-on seasonality-based reversal. Just be careful based on the past performance. I know it doesn't predict future results, but you'd be a fool to ignore the past. That's all I'm saying. Be cautious, be ready, be open-minded. And in this case, if it breaks, you get paid. Woo! Now the reverse could happen too, and this could drop and you get busted out theoretically at break even. Okay? You got it? News comes out. There's the important line in the sand that we'll need to charge. Looking for a Fibonacci retracement. Okay? Stop should be below 148.53. Stop should be at break even by the time we hit the line in the sand. This is a bayonet charge. And moment of truth. So if I hit save, it doesn't close. Oh, fine. TradeTheNews.com.
Just a few seconds. Payrolls 148,000 over 190. Expected prior tag 252,000, 228,000. Unemployment remaining at 4.1% as expected. Trade balance at minus 50.5 billion, wider than the minus 49.9 billion expected. Prior revised a little wider to minus 48.9 billion dollars. Hourly earnings at 0.3% is in line with expectation. 2.5% in line. On a year-over-year basis, weekly hours remaining at 34.5 as expected on the hourly earnings. The back month revised lower to 0.1% month per month and a 2.4% year-over-year.
We're just looking for resistance.
Downtick on both of those. Canada unemployment dropping to 5.7%, 0.3 lower than expected. And unemployment change at 78.6 thousand, a much bigger rise in employment than the 2,000 jobs expected for Canada. And merchandise trade minus 2.5 billion. Wider deficit than the minus 1.1 billion expected. Non-farm payrolls at 148,000 for the U.S., below the 190 expected for the back month revised. Higher by more than 20,000, 252,000.
Back month revised up. Thank you, TradeTheNews.com. Thank you, moderator, for posting the number. In a place, da 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 da. Yeah, only will wait for me. So I was looking around. There's no reason for it to pull back here, unless I guess we got to look price or something. Okay, let's do it that way. There's a bit here and there's a bit there. All right. So we'll do it that way, go into a small time frame. So there's a price resistance here, but market resistance is quite a bit further up. So sort of a, like we talked about before, something like this is what we'd be looking for. How long must you wait for me? Yeah. Something like that? So typically what I do is I measure the news candle, so that's about here. It's already moving off the 5. So this is what we've been doing, the clients and I at Traders Way. Check that out, huh? It's a long time to be bullish on euro dollar. Yeah, CAD had a good number too, didn't it? Remember, we got the CAD results as well. But this even shows that we're really seriously approaching a top. Very, very seriously approaching a top. Which would fit well into my idea that what if, just being open-minded, what if the funding currency strengthened instead of weakened? What if you get like a Swiss franc rally, a yen rally, maybe even a dollar rally off these tops or whatever? It could happen. I'm not, right? The next best thing is to let it break higher and then buy the dip and trade it like a breakout. But it's very difficult to buy it in here on the medium to long term. Now what happens today because of NFP or even in the next couple of hours is much different. So you can do whatever you want. Okay. So going back to here, what do you think? Decision making time. Mr. C says USD yen only moved 30 pips. Yeah, because they're both the USD and Japanese yen are funding pairs, so that would make sense. They're either both strong or they're both weak. Okay, it hit my 3A2 and wicked. So what we'll do after this is we'll look around the world, see what else happened. In particular, we'll look at commodities, commodity currencies. And I have a Turkish lira trade that's been open now for 2 weeks. Based on my calculations of what Traders Way pays in interest payments, you know, the yield you collect on that carry, if I hold that trade for 1 year, I'll earn 325% interest, assuming I make no pips, which I think is pretty funny. You want to try it? Let's see what happens here. So I think that's funny because, you know, and that's based on the money I actually use to right, for the trade. So I use some cash and then I collect some interest every day, right? So I don't know about you, but 325% interest is a pretty good return for a loan. I'm loaning the government of Turkey money. Now, of course, through the power of Traders Way, I get some leverage. Thank you, Traders Way. So I'm lending them a lot more than my cash. So I think that's pretty cool. That's how you get the 325% because of the leverage, right? So that's nice. Now, if I bought a bond, if I bought a Turkish lira bond I'm not going to have that kind of leverage, right? So I'm not going to get the same type of returns. Nice thing about Forex is it's liquid, right? It's the cash market, and I can move my stop to break even, which I've done. And in fact, I've locked in 2,000 pips or something, so I can't really lose money. So I can sit on it, collect the interest. The cool thing is the pips are worth way more than the interest payments. But if I can just be strong and stay in that position for 1 year, I'll collect 325%. I just need global macroeconomics just to continue to improve, and I think I'll do well on that. So I might make a lot on the pips and collect 325. It's amazing to think that 325% is icing on the cake. I'm like, icing on the cake? That sounds like 5 cakes with icing. That's like a wedding cake. What you expect when unemployment is for, like I said earlier, the unemployment rate is irrelevant. Doesn't matter. We're at full employment, otherwise known as the natural rate of unemployment. So the only way for that to go up and down is really for workers to enter or exit the market. Most likely we'll go back to more like closer to 5. And the reason I say that is people that are not in the workforce, because remember the way that you get the number is you count those that are essentially frictionally or structured.
Following the strongly expected Canadian jobs report, the dollar Canada lowered by almost
So based on those that are frictionally unemployed and cyclically unemployed, right? And they're actively looking for jobs. You come up for the number and it's 4.1%, which means there's a lot of people that don't have jobs, that are not looking for jobs, that are just not even counted because they're not actually in the workforce. But they could easily just show up and come to the workforce because the jobs are good and they're paying well again as wages go up, right? So someone that hasn't been looking for a job in 5 or 6 years, right? Maybe they said, oh, the economy's crashed and I'm 50 years old, so I'll just retire early. And then all of a sudden, 10 years goes by, they're 60, and all of a sudden they can get a good job and work another 5 to 10 years and collect good money, and they're like, maybe I'll come back to the workforce, whatever. So they come back to the workforce, and now they're counted, but they don't have a job, and so the unemployment rate could go all the way back to 5. Still irrelevant. We're still at full employment. We're still at the natural rate of unemployment. Okay. Well, that collapsed on me, right? So there's your 786. You could do another one there if you're a cheeky little monkey. Okay. Look at this, though. Like I was trying to show you, there's this, but if you back out even further, it's a real top going all the way back. Let me click back one more. It's a real top. It's a real top. It could really be. It could be a really big move. Art says, Wayne, hello again. Hello, Art. You talked about market support and resistance, price support and resistance. Could you talk more about them, please? Yeah. Let me do that a little bit later once the volatility's calmed down, okay? So here's the other 786 opportunity, right? If you wanted to try it. Someone might also measure it here, so I can do it that way, but we know this is our 786 of the news candle. I bought a little kick off the 382 just to show you. Okay. Now the 786 is wicked twice. It's pretty hopeful. So if someone longed here, they're only risking from here to here, because your stop would still be the same. Right? That kind of thing. Whether you bought it at the 786 or the 382, your stop's basically going to be the same thing, right? You're just risking less because you were more patient. For me, I'm just trying to get some eye candy down for you guys to see. It's getting warm in here. It's getting hot in here. All right, somebody asked about 325% on what? All right, let me show you then. I did a big conversation about 3-4 weeks ago with clients at Traders Way about macroeconomics, and we looked at some indicators that showed that things may be improving. We looked at things like the Baltic Dry Index, for example. We said, okay, let's discuss how a hedge fund manager might look at these fundamental, this fundamental analysis and put it to work into a trade, right? So we went through all of that. We talked about fundamentals, macroeconomics, this, that, and the other thing, and iron ore and coal and shipping prices. And we went through a lot of things. We even looked at indicators that would show oil would go up based on weather in the northeast of the United States. Not joking. Now we got a cold snap and oil prices skyrocketed another $5, and we talked about it 3 weeks ago. But anyways, so we went through this whole thing, and I said, well, let's look at a trade that you probably haven't looked at before that would probably benefit from improving macroeconomic conditions. And what we ended up doing as the example was this trade here. And we sold, I don't have a drawing tool, too bad. All right, we sold right here, right? One of these little retracements. You can see the trade is right there. Okay. This was a discussion, I think, just yesterday. If it reversed, that's how it would do it. Okay. This dotted red line is where my stop loss is, so I've locked in 2,000 pips or something, so I can move more. And you can see to the left, no, sorry, 6,000. Look at that, 7,000 pips locked in. No, I love it. 8,100 pips. All right, 9,000 pips profit locked in. Oh, 8, 7, sorry. There's 9. All right, I know it's lira, so 9,000 pips sounds like a lot. It's laughable, right? But it's still funny. By the way, we just hit a major target. This is a huge take profit zone. So if I was a cheeky little monkey, I would take my 12,000 pips or whatever it is profit. But I want to go back to the lesson. We sold here based on a discussion. So this is 1, 2, it was 3 weeks ago. Okay, a full 3 weeks ago. But anyways, so the discussion had to do with a couple of things. Like I said, macroeconomics, and then I also talked about yield differentials. Okay, so this is just one mini lot. It's not a big deal, right? It's not a big deal. And so here's this Euro USD trade we made earlier, whatever. You can see though, since the 18th, I've made $14 in interest. Doesn't sound like a lot. If it was one standard lot, it'd be $140 in interest. Okay? $140 in interest. But in 3 weeks, on one standard lot, I think one standard lot costs $800. But I've already made back $140, not including the $300. Well, in that case, it'd be $3,000, right? Because on one standard lot. So I would have made $3,000 in the on the pips, but I'm not even talking about that. 14 on the mini, 140 on the standard, 140, right? So now I got to go. Oh wow, double mouses. There we go. Calculator. Okay, this one. Right, so what do I do? Is it 140 over 800, or is it the other way? I think over 800. Okay, so just shy of 20%. Okay? It's only been about 3 weeks, and I made 20% return in interest. It's less than a month and 17.5%. I'm going to clear like 25% a month on the money that I put on here just in the swap. So it turns out, so on a, I think it pays $7.5 a day on a standard, I think it was, times $365 a day. 2,000, but I've only invested 800, so you divide that by 800. 242%. So I think it paid less than I think it pays 7.1. Let me clear that out. $7.10 a day times 365 days a year, because you earn interest every single day, equals, divide that by 800. This is how much you would have invested to get the trade. Yeah, there you go. 324% a year just in interest. Like, what? What the holy out about? Oh yeah, plus I'm already up 300% in pips. Right? Dan's like, oh my God, if it keeps going down, you're in business. Well, that's what the conversation was about. Up here, global macroeconomics seems to be improving. Let's look at multiple data points that would point toward this. And if you thought this was true, if this was your alpha, then you put together a portfolio based on this idea of improving global macroeconomics. One of the things you could do is this particular trade that would benefit if your analysis is correct, plus it's got the high carry. Right, so as the Fed raises interest rates, the differential will change, but then Turkey will be doing some stuff over the same period of time and probably more aggressively. But more importantly, I think what's happening is as Europe improves, there'll be less and less reason to be investing into Europe the same way. You see, it started with the United States. Then that got fully invested and overpriced, so Europe was cheap. So you start buying into Europe, and let's say over the course of the year, there'll be less and less deals, and investors will be more and more open-minded to take on a little bit riskier deals to catch the yield, right? Or return. In this case, so once they bought enough Dutch companies and German companies, no one would buy a Spanish or French company, right? Maybe a Greek bank. I mean, at some point you're like, how about an Italian bank? How about Turkey? So one of the things we talked about, in fact, I don't have a drawing tool. I wish I did. I want to draw this idea. I guess I can't really do it. I can't do it. I need a drawing tool. What I wanted to do is draw something that showed you a diminishing returns curve, and how when you invest into a developed country, you actually get less bang for your buck because it's already developed. So to develop productivity, you have to have either capital or labor, right? K being capital or labor. And developed countries tend to be labor short anyways, so that therefore they tend to be capital intensive. So we have really good factories in the United States, for example, right? But it's really, really hard. If you add more machinery or better machinery, it's very hard. I mean, you might add a ton of money, so you're like, we have the most sophisticated factory in the whole world, but it might only be 10%, right? More productive, and it might cost 500% more money to build, right? But you'll get per unit cost down. Great, right? Yeah, Econ 101. But in developing country where their labor, right? They're long labor. They have lots of labor, but very little capital, very few factories, and the factories they have old equipment and all that kind of stuff. So if you just add a few $1 million, you're like, oh, let's put some new equipment into this old factory, suddenly production doubles and triples, right? So that shows, but over time, as you invest more and more money and build up their capital more and more and more, you get a diminishing return. So your first time you do it, it doubles, and then it only goes up by 50%, and then you add more money again, and then it only goes up 25%, and pretty soon you get a flat line, and that's what I want to draw there. So at some point, the United States is way overpriced. The Dow is at 25,000. It's just absolutely amazing. So then you go over to Europe, and you start buying some cheap, European companies that have been around for a long time, and all that kind of stuff. We're just undervalued because of the situation globally, right? But then all those got snapped up, but that's why the euro's strong now. That's a normal thing. So as those deals go away and are harder and harder to find or offer less and less return, then suddenly an investor says, well, what if I go back to Turkey? I mean, all this money we invested in the 90s and the aughts into Turkey, it's still there and it still has potential, but it's way undervalued because of the whole financial situation and all that. So all of a sudden they're like, let's go back to Turkey. Are there still deals, right? There's still deals out there in Turkey. And so it's so low that maybe you get a higher return because it's so cheap. If you want to look at it as a value type thing, right? So whatever. Money, I think, is gone from the United States and then it's gone to Europe, and then it'll go to Europe and it'll go to emerging markets. One of them might be Turkey because Turkey was already heavily invested in the past. So there's some good deals there. Money starts going there, and I already own it. I already own the lira and that kind of stuff. So, but the way I look at it is I look at it more like a bond trader. Okay? My stop is not even at break even. I have 9,000 pips profit locked in. Right? So like, I can't lose money. The worst I can do is make 9,000 pips profit. Now, a pip's not worth much, so I'm laughing, right? So it's more like 900 pips on a Euro USD or something, right? So I'm on a mini lot, one mini lot, $300. So that's only like 300 pips. So I'm only up 300 pips, basically, right? But here's the thing. If you look at it as a bond, what if you slowly built a bond portfolio, a leveraged bond portfolio? Every time you move your stop to break even, you can't lose money. Well, same thing like a bond. Like you lend a company or a country money. The theory is they can't go bankrupt. I mean, they can. There's some, especially in the corporates. But it's still pretty rare, and you're warned about these things through risk or whatever. But whatever. Let's just say the idea is you lend a company or a country money, and they will pay it back. Now, if it's a treasury, that you are guaranteed, it's risk-free. They will pay you back, right? There are other risks, but whatever. So you lend Turkey money, and then they pay you back. You get your money back, okay? Well, I'm at that situation where I can get my money back, so I haven't risked any money. My stop, in fact, I can only make money, okay? So, right, in this case, I risked $80, and the worst I can do is make 300. That's not bad. Okay, so whatever. But I could still have my stop at break even and try to sit on this for a year. I could also do that. In that case, my stop's way back here. Okay? All right, so I will get my money back. There's no doubt. Now I'm earning 325% a year because I've leveraged it up to the yin-yang. Right? I'm not collecting 3.25 like if I lent it to the government directly. I'm leveraged 101, so I'm getting 325. Cool. So what if then over the period of time I added another one here, and 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 slowly over time you're building these positions, each time lending more money to the government, each time moving your stop to break even, and each time now compounding. Every time you lend the money and remove your stop to break even, you're collecting 325% on your original money because of the leverage. It's great. That's pretty good. That's kind of how I looked at it. And that's what we were talking about way back here. And then I said, well, let's just do it. I'll just show you. Okay? And that would be a portfolio type idea. So do you think USD Turkish lira is going to go lower? Okay, it's not a think. Okay, I don't think anything. So we looked at global macroeconomic data. Okay, that's all it was. And we looked at the trend in that data, and we came up with a hypothesis for the future. That's all it is. Then, based on that, we said, well, who would be the winners and who would be the losers? The US dollar should weaken, and our bias is short US dollar. It has been for, like, if I go back to, where did we have it? One of the, well, the one I showed you earlier. I forget which chart it was now. I showed you in the big long arrow that went left to right and went back like a year and a half or something. Euro dollar up. Well, that explains this whole idea where money needed to flow from the United States to Europe because the United States was overpriced, so it was time to invest into Europe. And I talked a lot about that over the last year and a half. It actually started on the taper, when the Fed started to taper. So we got that weakness. So I'm bearish on US dollar, have been for probably years now. Okay, great. Then, would Turkey benefit from an improving macroeconomic economy? Okay. That's all the thought was. When the U.S. economy is good, when the global economy is good, the U.S. dollar is weak. It's just part of the structure of how the world works. So I want to be short dollar. And when macroeconomic conditions are improving, once the developed countries have stabilized, then typically developing countries start to benefit, and in fact benefit quicker, simply because of the catch-up theory. And there's a whole theory. A guy won a Nobel Prize on it. You have to study economics to know these things, but it doesn't matter, right? It's just that's where productivity has a greater impact in less developed economies, and therefore a higher rate of return. So, long story short, if all this comes together and the genie in the bottle is real, ta-da! Turkey might benefit. But I'm a yield hog. I'm also in it because I love the 325%. Boom, boom, boom. Okay? Yeah, thank you, Den. So Den says, it's been 3 weeks, just on the swap, the trade has already made 17%. 17.5%. Okay. In 3 weeks. So, right, I'm not counting the $300 in pips. Just the swap. Just the interest that Turkey is paying me. Every single day, I collect interest from Turkey. Thank you, Turkey. Thank you, Turkey. Thank you, Turkey. Thank you, Turkey. Oh, I love all these payments, right? Every single day. Now, they don't pay me Saturday and Sunday, so I get 3 days payment every Wednesday. Cool, right? But I collect interest 7 days a week, 24 hours a day. Yeah. So when I talk about these things, and by the way, I've been doing this stuff for like more than a decade. I've been teaching people this stuff, right? So there was a time when like Kiwi yen was paying 8.5%, which means we're making 850% a year. I mean, so like this Turkish lira stuff's nothing. But just sort of a history of the Forex world, if you will. And by the way, this trade is still alive. It's about to bust out, but that's fine. It's just a scalp. All right. The history of the Forex world. The first Forex hedge fund ever created was something called FX Concepts, run by a man named John Taylor. And John Taylor started it literally as a hedge fund to hedge risk for importers and exporters and that kind of stuff, and large institutions. Started to attract money. But with that upbringing, if you will, the genesis, the idea was to not make pips. So he told his clients, look, I'll hedge your positions. I'll collect the interest if I can, but don't worry about it. But we'll try not to make pips because I'm going to lock you in, but I'm going to take care of myself by paying myself the interest payments. And they're like, fine, we just want to lock in today's price, you know, in the future. So he started doing that. And he started doing very well. And then it got larger pension funds and stuff like the lack of volatility, which being hedged creates, right? It's like diversity. Can you get rich with a diversified portfolio? No. Because when you have winners, then you have losers, and nothing happens. And so, but when you're a $1 billion pension fund or $100 billion, $1 trillion pension fund, you don't want volatility at all. Like, you hate it, right? So they started investing into his stuff because it doesn't produce volatility, so on and so forth. So he ran this sucker for 40 years and was paying himself $250 million a year. Now, that's not the return for his fund. That was his personal salary as a Forex trader, $250 million. And at that time, I'm like, that's the highest paid Forex trader I knew of in my research. So I'm like, John Taylor's my man. He's the guy I have to beat. I got to knock this guy off the pedestal. So, because I'd like to make $250 million a year. That's not bad. But bear in mind, it was based on his fund not earning pips. Only the carry, only the yield, only the interest payments on the positions. How cool is that? Well, when all the central banks went to a zero interest rate policy, there wasn't a carry, and so he couldn't earn any money. But then all his clients, which were invested in other markets too, were losing in all these markets because remember, everything was crashing. So he got killed with redemptions of all these, you know, all his clients are saying, just give me my money back, just give me my money back. Because they had to pay for losses other places, and they had to show their investors they were in cash and there was no risk and all this kind of stuff. So he was in business for 40 years and got pushed out of business, and it wasn't even his fault. But here's what I'm trying to get to. For decades, he ran a Forex fund that didn't even try to make pips. And I've been telling people, even in these webinars at FX Street, not just Traders Way clients, right? But over the years, I say, look, like 2-3 years ago, I'm like, look, you don't see carries. You might not even know what a carry trade is anymore, right? And every central bank's at zero. There's no carry. There's no carry trade. But I said, mark my words, one day it'll come back and it'll be a very important part of what you do as a professional Forex trader. And this is the first example, really, I think, that shows the power of a return, because that's a lot better than what your bank account's paying. It's a lot better than what U.S. Treasuries are paying. You buy a 10-year T-note, you get 2.42% per year, right? Now I'm earning that per day. There's a big difference. So what if you had a Forex fund and all you did was jam your Turkish lira stops to break even, and you're collecting 25% a month? That's not bad. Now, that's on the cash deployed, right? You're going to have all this dry powder left. Oh, this is going to get knocked out. You're going to have all this dry powder left, right? Okay, so that got knocked out, but let's go back to this dollar thing and the yen thing. No, not that one, this one. Okay, I said less than an hour ago that in history's past, around this non-farm payrolls and next week, in the past, we've seen yen strength develop, even though yen has been weak for a long time. Just keep that in mind. I don't see a lot of green candles. The only green candle I see is on the good CAD news. So everything else the yen is generally stronger than it was. Yet Den says, I've been saying that, yeah, but that's my job as an educator to say there's more than just throwing down a trade and making 25 pips on a 15-minute chart. There's more to currency trading than that. Because if you've done currency trading, let's say for 2 or 3 years, and that's what your strategy has been, 25 pips here, 25 pips there, take this cross, take that cross, 25 pips, 50 pips once in a while, and all you're doing is that shorter-term time, that shorter-term trading, what you find out is it's a lot of hard work. You're doing it all day, every day, just laser focus, and I bet you're not much better than break-even profit-wise. Your losses are probably about 20 or 50 pips. Your winners are about 25 or 50 pips. And even if you're like, what, a 60-40 winner, it doesn't pay you that much money. So then you got to jack up your leverage to collect huge, so that your winners can be bigger than the losers. But if you ever go 60-40 for a while, you're going to drop your account size by quite a bit. And as you know, the more it falls, the more you have to make to get it back to break even, right? So like, for example, if you lose 50% of your trade account, you have to make 100% return just to get back to where you were. But if you suck so bad you lost 50%, how the hell are you going to get to 100% just to get back to not making any money? Most likely you're going to do it by jacking up leverage even more and you blow up your trading account. And it's cliche, so it's not even your fault. You're just making the same mistake that 95% of people make. So I try to broaden it beyond that, because I love scalping, I love spot trading, but there's more to it. You need to swing, you need to carry, you need to position, you need to do all these things and be well-rounded both technically and fundamentally. That doesn't sound like bad advice, does it? That you have to be technically sound as well as fundamentally sound and have a mix of strategies, both short, medium, and long term? Doesn't hurt to be well-rounded, is my advice. Okay? I think it's good advice. Of course that's good advice! Gee whiz. So, be careful, don't worry. So, does anyone have thoughts on the carry and interest and yield? Did anyone kind of miss the whole idea of swap and all that kind of stuff? Did I leave anyone behind? And how about this? Do you remember when that Turkish lira was all the way down here and I said I should take it, but I'm not for the sake of letting it run for educational purposes? But we were right on that green line. I'm like, that's where you should take profit. That's the projected bottom. And look at that. It's bounced completely off and even to the pip. Look how precise that is. Isn't that amazing? That was the target on Monday. This exact, and it's to the pip. Is that cool? Are you telling me that's random? They came down and hit that exact price and stopped? I drew this green area Sunday night. It's Friday morning. Like, oh my God, it came down to the pip. And look at, these pips are down to like the 7th digit. And that means the accuracy here is to the 7th digit. The bottom is 3.7316. You're like, wow. It's actually 1.73125. It didn't go to 1.73124. It didn't go to 1.37156. No, it came down to 1.3 37125. Amazing, right? Isn't that amazing? And when I teach people to swing trade, we talk about these things like Sunday night, like, yep, there's the target. There's the target A. So if I was a cheeky monkey and if I was doing a weekly swing trade, that would be the exit, of course. Okay? But you can also change your setup and say it's not a weekly, it's a monthly. Okay? In that case, my target for the Turkish lira yen is 3.65115. The conservative target is 3.68566. I mean, that's very specific, right? Cool. Hey, moderator, does everybody watching on YouTube live, do they know where the chat link is so that they can communicate directly? Are you posting that every like 6 minutes? Like, hey, come to the live chat. Because I have another, what, hour and a half or so? No, I have another hour and 15 minutes. Which is basically open mic night, where you can come to the mic and ask questions. In this case, you can type your questions. So if moderator, you can make sure the YouTube people have the link to the chat. I'll talk about anything that anyone wants to talk about regarding Forex or even trader psychology. Yeah, I figured. Just put it like every 5 minutes. Chat link is in the YouTube description, all that cool. Because they should ask the question there, that's all. But thank you, moderator. Rin says, are there other currency pairs that have great interest? Yes, but not many. So this is a food for thought, gesture. Because 3, 4, 5 years ago when I was giving you the same information, there generally wasn't anything to do carry-wise because carries were so low, right? But also global macroeconomics was mixed at best. So we didn't have the conditions, right? It's sort of like having all the ingredients for a cake, but putting it in an oven that's not nearly as hot as it's supposed to be, right? Putting it in a warm oven versus a hot oven, it's not going to work out, right? So when I talked about this, and this is just simply an example trade, when we talked about it, it was more like, at what point as an analyst, because that's, what we do is basically analysis, and then if you can actually trade it, then you're a trader, right? But that's the next big step, right? The first part is the analysis. And based on the analysis, what is your bias? What is your outlook for the next 6 months to 12 months to 24 months? And you'd have to speak to things about demand for exports and imports globally, central banking policies globally, inflation risks, employment risks, geopolitical risks, all this kind of stuff. What is happening around the world? How's Australia doing? Well, look at iron ore and coal prices. How's New Zealand looking? Well, look at dairy and lactose prices. How's Canada doing? Well, look at oil prices and wheat prices and beef prices and K-car prices. And, how's the United States doing? Well, that's going to be a function of this, that, and the other thing. Well, what about Europe? And who tends to benefit at the next stage of that? So if Europe does well over the next year, what's the next stage 2 years from now? And how can we start cornering the market on that stuff now or soon, or when should we even look for that kind of data? Because, you know, all this information, most of it's irrelevant, right? So when does it become relevant? And it's that thinking process that I keep trying to push people into, that Forex is more than a video game with a bunch of charts and boo-boo, 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 I made 25 pips on the Euro USD, boo-boo, boo-boo, oh, I lost 25 pips on the Euro USD. There's more to it than that if you want to be a professional. But what a rewarding career it is, huh? Okay, got to go back to the technical question about support, resistance, and market and price. Okay. So let's break this down. And look at what? No. Guess this one. Okay. This is the one I showed you just as we were starting. By the way, it looks like maybe a head and shoulders setting up, and that's actually the right shoulder of the bigger one. Remember, if this comes down and yen starts coming down, could be the change of something significant. Could be. Okay. All right, so anyways, the first thing you need to do, I believe, as a currency trader, we can get rid of most of this stuff. Most of this stuff's irrelevant, doesn't matter. So let's just get rid of it all. Okay. You don't need any moving averages to trade. Okay. You don't need to trade the way I trade to be successful. Let's just be clear. Okay. My way is my way. I'm good at my way. You might suck at my way. That's fine. But you might be successful somewhere else. So let's talk about what I think are the ground strokes of trading. If you can't do this, you'll just suck no matter what you do. Okay? The first thing is you must be able to identify levels of support and resistance. Things like this. Okay? This is the basis of all trading, what we consider support and resistance. And then you can add levels of complexity to that later, right? You see how these levels were important in the past and how they became important in the future? This is the basis of everything. If it's been support or resistance in the past, it's going to be support and resistance in the future. I mean, look at even the spike, right? Straight up, straight down, back into these areas. Big counter trend trade. I'm telling you, this really kills the euro dollar up. And I've been euro dollar up for a long time. I took profit just before Christmas or just after Christmas. I can't remember. So now I'm looking for new things, right? I'm very open-minded. Okay? So this is basic. This is what I call support and resistance of price. You're looking at previous levels of price that were important in the past, right? And you're paying attention to them, the same levels later on in the future. Okay? I'm just going very basic here. Okay? For example, you might see this one, you might see that one. It's all up to you. But the better you are at identifying support and resistance, okay, the better you are at identifying support and resistance, the better you're going to be as a trader. The better you will be as a trader. So, somebody wrote a book a long time ago. He said he went to Japan and translated from Japanese into English Japanese trading pattern, candlestick patterns, and brought them to the Western world. And the book was like $500, and it had 7,322 different candlestick patterns. A says, why did I choose to be chief strategist for Traders Way instead of another company? Well, they treat me well and they asked me. Anyways, so the sum of the book, I haven't actually read the book, but someone else told me. I think he did. If you have a reversal pattern at support or resistance, it has a propensity to want to reverse. If you have a reversal pattern that's not at support and resistance, it has a propensity to not reverse. Which means the most important thing is support and resistance. Because if you see something and it's not at support and resistance, you're not seeing reality. Your beautiful little brain is making it up. So that is the most important thing. And actually, it's a leading indicator, because if it was resistance here, when we're up here, we already know to look left and say, oh my God, it used to be resistance. So I'm already worried about that level. It's the reason it works, because other people are worried about it too. So they take profit. They're not selling, and this is oscillators and like divergence in oscillators will tell you that they're not actually selling, they're taking profit, and you can get really clever and all these different things, but we don't need to be clever to be successful. In fact, being clever is usually a bad thing. Okay, but anyways, what happened in the past may be important in the future, and you'll see it over and over and over again. So the first step to becoming a better trader is to get really, really good at identifying price levels of resistance and support. The next step is to use price. The market. So that's price. Because of this price, because of that price, because of that price, because of this price, because of that price. It's all price-based, right? Now we can look at market support and resistance. And we can do it like, we'll do monthly here. Okay. And once again, let me get rid of the indicators, because I'm saying you don't need these indicators to be successful. I use them for particular reasons. I don't have to have them at all. None of these things I have to have. But I have to know support and resistance. You understand that part? That's the whole point I'm trying to make. You don't need oscillators. You don't need moving averages. You don't need your CCI. You don't need your ADX. You don't need anything. Okay, all this kind of stuff. All right, so now the next level is it's looking at the market. I'm not looking at price now. What I'm looking at is this is an important pivot. And to calculate this pivot, it had to look at the high, the low, and the close of the previous period. Let me try to get that in. Okay, it looked at the high, the low, and close. Or you can do open, high, low, close. Or open, low, high, and close. Okay, whatever. Divide those by 4 and you get the central pivot, and from the central pivot you can get these pivots, and from those pivots you can get the central pivots and all this kind of stuff. But what it's looking at is the previous period. It's not necessarily looking at any of these other prices. It just is looking at, the simple one is the high, low, and the close divided by 3. Okay, just the high of the previous period, so the high of last week, the low of last week, where the week closed. So it's not an average. The central pivot's not an average. It's a weighted average. See, if you go high and low divided by 2, you get the average, which would be a little bit, well, it'd be about the same. If you go high, low, and close divided by 3, what it's doing is it's adding market sentiment at the end of the period. In this case, at the end of the week ended bullish. It started low, it made a much higher high, and then on Friday's close, it closed much higher than the open. So therefore, it closed bullish and will have a propensity to be bullish again in the future. Now, if you've taken my swing trading course, okay, my swing trading course tells you in that scenario, you want to buy at this price. Did you know that? That price. Not this price, not this price, not this price, not that 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 price, That price, 117.27. You knew that Sunday morning. That's when it opened, when I could do pivots, right? At the beginning of the week, right? Well, if you're a bull and it closed bullish, you don't want to buy here, 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 you want to buy there! And the idea is it goes up, and the target was here. We never hit the target, but maybe. Okay? So on and so forth. And then if you use this, that may help you as well. So there's the difference. So to get these numbers, they are levels of support and resistance. This is a level you should take profit. This is a level you should take profit, for example. This is a level you should take profit. So in this case, you're a bear. Hey, bears, you should take profit. Hey, bulls, you should take profit. Okay? And all we're looking at now, it's a leading indicator, just like support and resistance of price, but this hasn't anything to do with individual levels of price, just the extreme levels of price. So basic calculations, bada bing, bada boom. Now we have a projected top for the month of January, projected bottom for the month of January. Okay? And that was all derived by what happened in December. So for the person who asked about the idea of support and resistance of market and price, okay, that's the M3. Oh, sorry, M2. That's the M2, I'm sorry. So a lot of people are asking me very basic questions like, how do you get those lines and colors and stuff? You need to visit tradersway.com right now. Open up a demo account. It takes less than 30 seconds. And in your back office, which is clean and beautiful and you will fall in love with, there's also a button that says webinars. You can trade with me like we're doing now every morning for free as a member and client of tradersway.com. So if you want to know more about these lines, how do I get those lines, and what is this, blah, blah, and you just want to talk to me for like not just today or, you know, or a special webinar coming up around the corner. No, it's every morning. Every single morning, 7:30 a.m. New York time, London lunch, 2 hours before New York opens. And you can ask me an hour and a half every day, day after day after day after day after day after day. My webinars have been running like 2 hours lately. So that's the price, free if you're a client. Swing on by tradersway.com. Give us an opportunity to earn your loyalty and respect. Okay? So, another question from, I don't know who this is. I don't know if I click it. Oh. Arnor. I guess that's Arnor, huh? Or Icelandic Viking. All right. So you hold trades for long term. Is that your trade? No. I scalp, I spot, I swing, I carry. So that goes back to what I was saying before. I think you should be well-rounded because there are times when scalping's great, especially in the summer. I tend to be a scalper spotter, and then going into the fall, I tend to try to be a portfolio trader, and then sort of like now, I'm more of a swing trader. Yeah, that's right, Robert. I think if you put in the HTTP, it just links you though. Yeah, that might be a little better. Yeah, D says, wait, what? Go to tradersway.com. See the big logo in the top right corner, Traders Way? We have, we have a website you can join for free, download MT4. Everything's good. Yeah, Dan's right. I try to fit the market conditions. And, one of the last things that There are two things that people, well, I guess three things. Three things that traders tend to learn last. That's fundamental analysis, which I cover every day because it's important, right? Multiple time frames, which is a bigger complex. Like you tend to do okay on a 15-minute chart for a while, and then the whole thing collapses on you, and you're like, I wonder why that happened. Well, you're missing things on other time frames. And then lastly, it's going to be the seasonality of fundamentals. Right, and it's not just fundamentals. It's just more like there are fundamental rules for planting wheat. Would you agree with that? Like there's general environmental conditions that are important. The time, and then how you dig a trench and put the seeds and cover it up, and the type of fertilizer you use, and all that kind of stuff, and the machines that you have for cutting it down on harvesting, and you kind of have to have all that kind of stuff, right? But what if you had all that stuff but didn't pay attention to the weather? Like you're out there in January plowing your fields and putting seeds in. September comes along, you're like, damn, where's my wheat? I have the right tools, right? I plowed it. It was a lot more difficult than I thought it'd be since the ground was frozen and covered in snow, but I followed all the rules to a T. Well, yeah, you had the right strategy, but very poor execution because you didn't line up things, right? You didn't line things up with seasonality. And because of business cycles, there's like annual seasonality, if you want to call it that, and then there's more larger business cycles so there's seasonality within the business cycle. Okay? And so we've troughed out now, and we're moving into an expansionary phase in the US economy, which means Europe is just troughing out now, and then someone else, maybe Turkey, will trough out soon once Europe hits more of an expansionary phase. So now that Europe is tapering, you listening to me? Now that Europe is tapering, that's generally a time when you buy the euro. But you can't forget about the seasonality thing. Okay? And then once Europe progresses through its economy and tapers out of its bond purchasing program into just simply zero interest rates, and then maybe a year or two later they'll start raising interest rates, kind of like what the Fed did, well then that gets them through different parts of the business cycle, which then leads other economies that are associated with Europe. Turkey is very much more associated with Europe than it is the US. So suddenly, when Europe goes through its business cycle and seasonality cycles, then Turkey will have its turn. The thing is, I like to be ahead of all of this. Okay? And if I can, very often I can benefit financially. Oh, Windows finished its update. Hang on. Yeah, pop in another question. I'm happy to help. Ah! Oh yeah, that's right. All right. So there you go, Bloomberg and CNBC going. Funny thing is, I don't have sound drivers on that PC, so I don't hear what they say because I don't care. Yeah, I have redundant air conditioning. Yeah. Wow, that's really weird. You click, you can't watch it. Well, first of all, I'm not running a webinar, but that app not set up. I'll have to ask their support to look into that. Dan says, are movements of this pair part of the course given the results? Well, the thing is, when I first started trading, we would have moved to like 1,000 pips. It would have dropped 300, would have risen 400, would have dropped 300. So, you know, for this to like move 40 pips and then flip and drop 40 pips was just sort of nothing. Okay. Just wondering what we should do now. What should we do now? Yeah, you have a real account. Yeah, that wouldn't be it, but you're talking about webinars, and it should just link you to the webinar page. So this app not set up and all, I'm not sure what that is. Maybe you're clicking something different. But I can't help you in the middle of a webinar, I'm sorry. Contact support. We have fantastic customer service, white glove, butler treatment. Yeah. Well, then I'll see you on Monday, Dee. And I welcome anyone else you want to visit on Monday, go through my webinar. You're welcome to join us. Just visit tradersway.com, and I'll see you Monday morning. Any other questions? Still have about 45 minutes. I traded the Mexican peso this month. Sold it, I think, in here. Got knocked out for profit down in here. Bottomed out. Kind of have to go this way. Isn't that amazing? It started at the 50% and dropped. What currency pairs should we be looking at? Well, anything dollar-based is where you should start. Our tech, there are thousands of pivot indicators now. So you just Google MT4 pivot points. Oh, well, commodity pairs. All right, so if global macroeconomics improve, if that's part of your basis, or your analysis, then if, you know, like oil, for example. Well, before we talk about oil, let's go here. All right. When we were, can't get in there. Daily, I guess I have to go. All right. When we were here, this double orange line here, price had been trying to go up and up and up and up and up and up. This is USD CAD. And we did our analysis together in the Traders Way webinars. We looked at this and saw that oil had been moving sideways for some time. But one of the things we talked about is on oil, not being bearish on oil, but sort of neutral to bullish on oil. And that if anything along the way makes oil rise, then this pair should fall. In this environment, in general, where we should also be bearish on the US dollar. So it's like US dollar we're already bearish on. For some reason, Canadian dollar is also fairly weak, but this is during a pausing period in oil. Oil had gone up for months and then had been moving sideways for weeks, but it's a pause, right? So we discussed in here, and we were still up in this zone here, that even though the Canadian dollar has been very, very weak, it's probably time to look to sell. And then we broke this down into much smaller bite-sized pieces because, you know, I do a webinar every day, so we're not using daily charts. And of course, I can't get in on smaller time frames. But there was a 1, 2, 3 pattern here, then there was a bigger one here, then there was a bigger one here. There were 3 reversal patterns, one at the top, one in the middle, one at the bottom. You can see I still have one of the X's here on the 50% Fibonacci retracement. And what that predicts, this one predicts, and this is the late one. I mean, this is after I was talking about it for 3 days, that this should be falling. Then this one predicts 50% predicts this, at least this move, which kind of coincides with this bottom. And that's why I have these blue lines mixed in with the green zone to say, whoa, 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 there's some serious support here. But we were short here, here, and here before it even started falling. Well, we talked about it here. Then there was a micro and a sort of a medium one, and then there was a macro. You can even see the little tiny little resistance I have in here from selling it on like a 15-minute chart, right? And then this is more like an hourly or 4-hour swing, right? So anyways, this ended up is still falling, and it's falling even further than I would expect. Do you know what the bottom is predicted to be? The conservative bottom for the month of January is 120.65. We just hit it. The aggressive one, if you're really bearish, is down there a little bit further. Did I miss it? Oh, you know what? I might be monthly. Where's the, that's M1. Where's the next one? Is that the monthly? Oh, it is the monthly. All right, so the next one is 119.36. So let's just call it, you know, at best, you're going to get this down to 120 because of the psychological level and stuff. Okay? But what prompted this, because you can see there's no real downward movement beforehand, it was fundamental analysis of the oil market. And that's how you end up doing the CAD. Okay? The CAD was moving sideways in this period. Can you see all these arrows I have on oil here? I'm trying to move this so it's easier to see. But we were obviously in smaller time frames back then, right? But you can see we're like up, up, up. Here's support. Buy it at support. It's retracing, but just down to support. Here's support. You could buy that. Here's support. You could buy that. And then you draw this area to know the breakout pullback type scenario. But this whole time, while that USD CAD was moving sideways, oil was moving sideways, and we were not bearish. We were not. And those conditions were not bullish either, but we're neutral to bullish. Like if it's going to do anything, it's going to hit support and then rise. So we're kind of betting on the bottom and not betting on the top kind of thing, right? And eventually it did break. Now, right before this break, I downloaded information from the Energy Information Agency, the EIA. The EIA had a report which I read to Traders Way clients, or discussed with Traders Way clients, and it said it had information about the report for, I think it was like 20 years of historical data for demand for heating fuel. And it broke it down by state. And from that I could figure out which states in the United States of America use the most heating oil. And we also know they use heating oil when it's cold. So we had this big discussion about 3-4 weeks ago that the analysis provided to me from the U.S. government showed me that the region from Philadelphia to Boston still uses a lot of heating oil relative to the rest of the United States because it's an older infrastructure. The rest of the United States uses natural gas and electricity and all that. Well, they use heating oil. Okay, great. So the discussion 3 weeks ago was, based on this information, we know that the producers of heating oil are oil refineries, and that when weather is supposed to get cold or becomes cold, colder than usual, you get a cold snap and a lot of snow and all that kind of stuff, demand for heating fuel, heating oil, will skyrocket, and the refiners are going to have to replace this product, because to them it's just a product. They make all kinds of products out of crude oil. One of them is heating oil. They also do jet fuel. They make tar. They make plastic. All this stuff comes from crude oil. So if there's going to be an increased demand for this particular product, well, they're going to have to make more of it to replace the diminished stocks, right? So we said that if Philadelphia, New York, and Boston gets unusually cold weather, demand for heating oil will go up because that fuel will be spent. Oil refineries will have to increase their purchases of crude oil, West Texas Intermediate. Because you don't buy WTI, I don't buy WTI. The only people that buy WTI are oil refineries that then refine it into products to sell it to people. You buy gasoline for your car. You don't buy WTI. You buy Pennzoil 10W30 for your car. You don't buy crude West Texas Intermediate. So with this in mind, with this government data, and this is what I call fundamentals, by the way, with the solid 20 years of analysis given to us by the U.S. government, I knew that if it got cold in specific states, the WTI was going to go up. We talked about it down in here. And guess what? There's a cold snap from Philadelphia to Boston right now. Central Park got over a foot of snow last night. Well, somebody saw that coming, and somebody was buying up WTI. Maybe it was the perceived or expected increase in demand for heating fuel by oil refineries, but we talked about that last month. So if you're buying WTI now, you're way too late, my friend. But that's kind of cool though, right? So this is kind of the stuff that we talk about in the mornings. So I hope to see you on Monday. So if this goes up, USD CAD should fall, and I had already shared that analysis with you where there was a short in here based on the analysis of oil. There was a short in here. These are all smaller time frames than what you're looking at now, so you can't quite see them. But there definitely is one here, which was clearly pre-written and all that kind of stuff. And that got us to down here. Now there's a new month, and now that we're hitting the conservative target and the aggressive targets there. So it may not see 120, but it might. But it all started with the analysis, the fundamental analysis of the energy complex. Doesn't that sound good? Hey, how's that Forex thing going? You're like, dude, I just went through and did fundamental analysis of the energy complex. And your buddy's going to say, dude, that sounds so complex. You're like, yes, we drink. Dia says, is news important or is it already factored in? Okay. The reason there's news, like economic news, is it's news, it's research done by government agencies or private agencies. It's used by the central bank to discern the health of the economy and what monetary policies need to be enacted. Because this is the basis of a lot of trading and a lot of financial markets, for example, the bond market, money market, all this kind of stuff, heavily influenced by this. So this data is released for transparency reasons. So you have the same information as the central bank. And if you know how to do that, if you know what it means, then you know how the central bank is going to interpret it. And if you understand central banking, you know what policies they're likely to act or not. And as a currency trader, you know how that will move currency prices and you make money. It's kind of like that easy, right? So is it important? Well, the individual events are not news, it's just data points. There's this idea that there's expected, unexpected. So it may be priced in, but if you get unexpected news, then it's going to create more volatility than news that's already baked in, right? And then there's sort of sentiment. If the market's already bullish and you get bullish news, it might move a lot. If the market's already bullish and you get bearish news, the market still might stay bullish. They're like, yeah, but it's not bearish enough. So, you know, so there's already kind of that kind of thing going. So those that are trading news events are trading the volatility that the events create, but it's not fundamental analysis. So like today's NFP, irrelevant to the Fed, irrelevant to the FOMC, irrelevant to all, you know, central banking in general. But it's not irrelevant. And in this case, what happened was it wasn't a very good number, and price jumped up, hit resistance, what I showed you, went all the way back several weeks, and just went up and collapsed on itself. And more importantly, I said based on seasonality, which is a form of fundamental analysis, in the past, this time of year, starting with non-farm payrolls, very often you'll see a collapse in the previous trends. You will see things like euro-dollar that's been up for a year suddenly is coming down. Do you remember a year ago when the stock market dropped 10% and everyone was freaking out? That maybe could happen again. I'm not saying it will, but if it does, I'm going to act on it because I'm already kind of ready. But that's what a trade plan is, guys. I don't know what's going to happen, but if I have an idea, like what if the stock market today and tomorrow, today and Monday and Tuesday and Wednesday has a reasonable decline based on just profit taking? It's happened in the past. It's not improbable. So if it happens, shouldn't I be thinking now, or in fact yesterday and the day before when I discussed it with Traders Way clients, I'm like, it may not happen. It could not happen. It might not happen. So we don't know if it'll happen. But if it's reasonable to assume it could happen, it might happen because it has happened in the past, then, well, how could we benefit from it financially? How can we make money if it does? And what kind of technical analysis would we look for to confirm that scenario? So if there is a stock market decline, what currencies tend to benefit? What currencies tend to be hurt by this scenario? What maybe just look at what happened last year. What happened? Now, it may not be the same because the dollar's in different scenarios. Global macroeconomic conditions are in different scenarios. Maybe the dollar doesn't strengthen, but maybe the yen does. Maybe the Swissy does. Who knows, right? But you can look at the past, get a general idea, and then look at the future, and then at least be ready. So I call it ambushing. So there's two ways to win a war. You could send your platoons walking through the jungle, randomly and aimlessly looking for bad guys. Hi-ho! Right? And you're just hiking through the jungle, and all of a sudden you come across some bad guys. Pretty random. At best, you're at a level playing field, right? All right, great. The other way is find paths that the enemy tends to walk through. Find their paths. Where do they tend to go this time of year, this time of month, this time of day? And you get there first, and you don't know if they're coming because you don't know what the enemy is doing. But you're like, well, they come down here a lot. There's clearly a path here. So you're like, you'll go there first. There's nobody there. It's really quiet. And you check everything out. And you're like, okay, there's a high ground. Set up a nest up there, machine gun nest. Let's set up some crossfire positions. Let's set up some booby traps. And then everyone gets in position, and then you sit there and you wait. And you could wait, and they don't walk by today. So at the end of the day, you pack all your stuff up and you hike back to base and you lived another day. Nothing happened, but you didn't die. It's better than randomly bumping into somebody. What if you walked right into, 500 guys? You're like, who are they? Look, I spotted the enemy, Sarge. You're like, dude, there's 500 of them and 25 of us, right? I mean, you don't want to be unprepared. You don't want to bump into your enemy. There's a reasonable chance that you're outgunned and outnumbered, right? So anyways, using the analogy right, if you're sitting there and you have ambushes all set up and crossfire positions and booby traps and high ground, and the enemy is walking by, we're looking for the best, and all of a sudden they step into your kill zone, you have an unfair advantage and you're probably going to win and survive. Okay? So I like that. I use that analogy sort of as a plan. There's a lot you don't know, and there's a lot of assumptions, but if everything goes right, you're going to have the upper hand. So I don't know if the stock market's going to crash. I'm not even saying it's going to. Right? And crash isn't the right word, but I'll tell you what, when it dropped 10% last year or the year before, whatever it was, my friends were freaking out. The guy came over and we were smoking cigars. He's like, his hands are shaking. I'm like, what's wrong with you, bro? Stock market's down for 10%. Should I get out? Wait, you told me when it was... Because I have this deal, I'm like, I'll tell him when the stock market's going to collapse. So he came, it's down 10%, you told me it was going to collapse. I'm like, whoa, bro. Whoa, you're fine. It'll be fine. I got some technical analysis. I've identified all this. There's nothing fundamentally that would make this. I think it's just profit taking, but if it breaks a certain line, I'll tell you when, but don't worry about it. And sure enough, now we're at Dow 25,000, right? So if that's the basis of every hypothesis, aka trade plan, if there's profit taking in the stock market, in the, let's say in the next 10 days, I'll be very specific. In the next 10 days, if there is, then you should identify which currencies could possibly benefit from that downward move in the US stock market, which ones will benefit, which ones will be hurt. Open up your charts, identify levels of resistance, and at least be open-minded to seeing reversal patterns. Because if you're not even open-minded to seeing it, then you'll get them and you won't even see them, right? So just say, well, this is interesting. This has happened in the past, this time of year, for probably Newtonian mechanical reasons, like booking profits, mutual funds taking profit the first week of the year. Because remember, they don't come back till the Monday after NFP, right? So the Monday after NFP, there might be huge profit taking from institutional investors and mutual funds and all kinds of stuff. And this sucker might drop for 3 weeks straight. And it'll drop faster than it went up. Because they say it goes up, the trading in the stock market is like, walking upstairs and then jumping off the top of the building. It'll come down fast, right? So you just kind of like, okay, my job as an analyst is to be aware that this might happen and have a plan to take advantage of it. And if I see certain triggers, like reversal patterns at resistance in the next 10 days, history shows me that maybe I should trade that. Yeah, it would be better to take the elevator down, right? Especially if you're carrying bags of money, right, Ryan? Like, what am I going to do with all this money? Well, take the elevator down, bro. Everyone else without a trade plan, and the ones that are usually hurt the most are the ones that have been long for so long, long-term long, and they don't see the seasonality aspect of it. So they ride it all the way down. It drops 10%. Now that they're down 10%, then they get out. And then, of course, the smarter trader would be tiptoeing back in, right? Yeah, wow. So maybe it happens, right? Maybe it happens. I hope you guys are enjoying the webinar. I do. We have a half an hour. How may I help you? By the way, YouTube guys, go to the FX Street chat room. Moderator's been posting a link. I think it's in the description as well. Ask questions. Swing over. Just click it. All it is the chat. It's not going to ask for your social security number or anything. Just enter the chat, participate, and don't be a lurker. Come on. Also, I believe I have 4,000 videos on YouTube. You might want to, if you're on YouTube, you might want to look for some of those videos and subscribe. Best way to stay in touch with me is either through Trader's Way, obviously, or through FX Bootcamp, which is video training. We're going to add live training to it as well, if you need some hand-holding through learning technical and fundamental analysis. Right? Like, for example, at fxbootcamp.com, there's a video training course for fundamental analysis, which I think is 20 hours long. And I'm about to do a couple more videos in the next week, maybe tomorrow. But anyways, that takes you through, you know, what money is, how money is used, and all that kind of stuff. Because if you're a currency trader, you have to have the right concept for money, right? And then you become the manager of a commercial bank, and I teach you how to manage your balance sheet and why this is important. And because it leads you to the creation of the fractional banking reserve system and how money is actually created. By the way, the Fed doesn't print money. So whatever you read or saw on TV, oh, the Fed's just printing money. The Fed doesn't print money, bro. So anyways, so then it goes into that. Well, if that's important, you know, that leads to monetary policy. How does monetary policy, what's the Fed funds rate? What's the discount rate? You know, that kind of stuff. What's the prime rate? What are these policies? What are they for? What does the Fed do? What did the Fed do during the financial crisis? And, you know, what kind of open market operations are there? What is the entire history of the Fed? You know, all that kind of stuff. And so I think the next video that I'm going to do is calculating CPI, how that's all done, and why that's important. Because obviously, if the central bank is worried about inflation, well, then we have to say, well, what is inflation, and how is inflation measured, and what is CPI, and why does it matter? Like a CPI number, what does that mean? And then, you know, is that in real terms or nominal terms? And so you have to kind of learn about that and the core and all that, and maybe do some basic calculations and stuff. And then I thought I'd do one on productivity, and that would be more GDP related. What is GDP? What are the components of GDP? But more importantly, what is nominal and what is real? And so I'm going to have to take you through the GDP deflator. And I bet you most people here have heard of the GDP deflator and have no clue what it is, right? Like, crickets. GDP deflator. What the is that, right? So I thought I would add to that. So if you need that kind of help where you need 20 hours of fundamental, that would be fxbootcamp.com. Oh, you asked to keep asking. Okay, here. All right. Okay. Art says, what is the best way to build the right mindset before, during, and after for trading? Yeah, that's interesting. We do talk a lot about that. because there isn't like one answer to that, Art, but it's something I do over time, especially with the daily webinars. We talk about how to appreciate being a trader, having the right mindset to be a trader, things like, you know, just enjoying. Like, I think we even talked about it yesterday a little bit about, you know, I've been doing this for, you know, 15 years or something, and I've almost never taken a day off. I've been sick a few times, but even then I generally coach when I'm sick. I take my laptop with me all over the world. You know, like in 2017 and 2016, just that period, I probably coached from 5 or 6 different countries all over the world. But I don't generally take time off, but it's because I'm a trader, right? Some of the trades that I made recently, so like in December, we were up, I don't know, 4,000 or 5,000 pips or something. I don't know, I think it was less than that, 3,000 pips. But a lot of those trades I made while on an airplane, either to or from Singapore. I got my laptop open and I'm making trades from 35,000 feet. I even attended one of my, so I'm in grad school at Harvard, and you know, I attend a lot of my classes online. You know, we attend online and you can see all the other students, and then you can see the students in the classroom and the professor, and we have a lot of guest speakers and stuff. And so I don't like to let the guest speakers kind of, I hate for them to lecture to basically an empty room, right? So I kind of be there because grad school classes are small, right? So anyways, so I log in from the airplane, flying at 35,000 feet. I'm somewhere between Shanghai and Seattle, and I log into my class, and I'm like this. And they're like, Wayne, where are you? Oh, I'm in my pod. I'm drinking my martini. In your pod? I'm like, oh yeah, I'm in an airplane over the Pacific Ocean. Yeah, so I can attend my classes live, and I can trade live and live. So it's just more like, there's a lot to being a full-time currency trader. It's very lonely. A lot of people don't get what you do. Your parents and your friends think you're a degenerate gambler, which might actually be the truth. And then learning all this is very difficult. So that's why it's good to have a community. This is, you know, I turned to FX Street when I first started 15 years ago. It was a tiny website, but there were other people that were interested in currency trading. It was pretty cool, right? And then I ended up starting my own community where we could actually trade, you know. So, so we do talk about things like how to continue making the work fun and interesting. And so I do things, for example, where I do, like, sometimes I read the newspaper, and that'll be like Barron's. And usually I skip all their stuff and I go to the end, and usually it talks about some sort of professional investor that has his own fund, his or her fund, and what they do and their specialities. And I kind of like that. So I kind of like reading bios more than anything. But I'll read that, and then I'll read, you know, central bank reports. I'll download and print those, and I might look at some IMF things, or like I told you before, the EIA, the EIA report on demand for heating oil. So I'll download that sucker, and I'll put them in a pile. And typically, on like a Saturday morning, I'll go out on the back deck. I have a beautiful view of a lake. In fact, my house is on a peninsula, so I have a 180-degree view of the lake. So I'll sit out there, and it's got the nice soft air, and the water's sparkling, and you can hear the ducks squawking. And I'll sit on the back deck in the warm sun and drinking my coffee, and I'll smoke a cigar, and it usually lasts like 2.5 hours. And I go through and I read the central bank reports, the EIA reports, the IMF reports. I'll read Barron's magazine about other traders, and then I'll read about some bonds and, you know, and this other kind of stuff. And I tried, instead of making it work, I kind of make it a reward. And if I wimp out and not do it, I cut a finger off. Well, actually, I don't do the second part, but I try to reward myself, and it's very important, especially if you're going to be a guy that sticks around or a gal that sticks around for a decade or two. You know, most people bail out in their first year to two, right? So how are you going to make it 15, 20 years? You better really like what you do. So like my children just know, like several years ago, I took them to Disney World. We were not there at the gates when the gates opened because Daddy works early in the morning. So Daddy is doing his research, he's doing his webinars with his clients and customers, right? And we go through the charts and we do our trade plans and we look at the support and resistance, the risk and the reward and all that kind of stuff. And it's routine and everything else can just wait. And when we're done, shut the laptop off and go, 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 go. Let's get to the front gate. Let's go hug Mickey. What's up, Mickey? Right? And it's just what you do, but even the kids are used to it. It's just what Daddy does. It's just the lifestyle, right? It's a lifestyle. Right? It's cool. And after a while, you like it. It's almost like bragging. So like, you know, sitting, so I took first class on Emirates Airlines recently. I was in Hong Kong, was talking to a big shot billionaire, and he's in Dubai, and he's like, yeah, well, you know, when can we meet? And I'm like, I'll get on a plane today. And he's like, well, you're in America. I'm like, no, I'm not in America. I'm in Hong Kong. I'm like halfway there. It's no big deal. So I get on a plane, and I get to, Delta doesn't fly Hong Kong to Dubai. It flies the other way around, but you can't go. So anyway, so I had to take Emirates. And people are like, oh, you got to go on Emirates. It's the best. So I'm like, boom, first class ticket to the Emirates, on Emirates Airline. And I'm up there in beautiful first class and everything. And I got my laptop open, but it's one of those long pods again, you know, and it's really big. It's almost like a private cabin. You can't even touch the screen. It's so far away. So that you have a remote because your cabin's so big, you have to have a remote for the TV. But anyways, so I'm getting another drink. And I'm like, hey, I'm out of this Johnny Walker Double Black because every little cabin, you know, has its own bar where you can just help yourself, right? I'm like, hey, I'm out of this Johnny Walker Black. She's like, well, if you go back to the lounge, the bartender will serve you. I'm like, what, bub? WTF? There's a lounge back there? So pack up the laptop, and there's a lounge and a bartender. Hey, I'm like, yeah, I want that Johnny Walker Black. Oh, well, let me get you one. You want it on the rocks? Yes, please. 2 ice cubes. Blip, blip, blip. I'm like, 2. Now I can sit out on a lounge chair, pop up my laptop. Let's do some currency trading. Glug, glug, glug. And all of a sudden, like, you just love it. It's like, what do you want to do? The only thing that would make it better would be a cigar, right? Well, you can't smoke a cigar on Emirates Airlines, right? But I can do it. So it's just cool, and you love it, right? I've had jobs. Have you ever had this where you wake up in the morning and the first thought in your mind, it's been less than 1 second that you've been awake, and the first thing you think of is you're sick and you're going to call in, sorry, boss, I'm sick today again. And I can't come to work because I feel like vomiting when I think of going to work. I've had that job. Okay? I've had that job. Now, I'm a currency trader, and I'm like, I love it. I don't want to stop. It's an addiction. I love it. And I share it with you guys every day, right? So it's kind of cool where you're on an airplane having a cocktail in the back lounge, trading Forex at 35,000 feet. You're moving 550 miles an hour. And you're trading. I mean, it's awesome. Lester's like, that's what led me to Forex. Yeah, good. So somebody asked about mentality, trader psychology, that kind of stuff. It's constant, and just visit on our daily webinars, and you'll join a community. Everyone else is trying to say the same, and we can work together. Yeah, it'd be off that support, right? John says finding bid. Well, it'd be off that support. There'd be some moving averages there as well. Let me just put that to a typical template now. Okay. All right. So I'd look for a head and shoulders on that, Johnny. Okay, NFP question. Would the number be so low because the unemployment number is already low? Well, I suppose, yeah. Okay, so I know what you're saying. So the headline number was low, but there's nobody available for jobs, right? So one thing that'd be interesting to see is how many jobs are available. That might be going up, but right, and we're not getting new people in. So I was listening to an interview, I think it was on NPR. This guy that owned a small builder company, we're building houses, and he's like, we're recruiting out of junior high. We can't get workers. 5 or 6 years ago, you know, there was 50 workers for every job. Now you can't find workers, so now they're like, we're recruiting in junior high, we're getting them right out of high school, they have no experience at anything, right? And they probably have tattoos on their neck and stuff. But anyways, these high school kids are walking right into the building and they're into apprenticeships, and we're like, this is a hammer, this is a nail, don't screw it up. So it's kind of interesting, we're at that point, right? So if you are experienced, you could probably demand a much better wage. So is NFP's headline number like $1.50, is that low because unemployment rate is so high? Plausibly. Okay, and what I was saying is the unemployment rate could rise simply because the higher wages that we're likely to be getting now and soon and in the future will suck more people out of what do you call the guys that are unemployed but not counted as in the employment, the destitute, desperate, whatever. These guys may re-enter the workforce looking for some of these jobs and raising the unemployment because they've actually raised the number of available workers so it changes the calculation. But it might be a really good thing. So being at 4.1 might not be good. Being at 5 might be a lot better because you're getting more people to work, and that's better for the economy. You understand that? Like, who cares about the unemployment rate? Well, you care when it's at 10, but do you care if it's at 4.5 or 4.3 or 4.6? No, you don't. What you want is a large workforce that can get jobs. That are frictionally unemployed, perfectly acceptable. Cyclically unemployed, perfectly acceptable and understandable to an economist. Might suck for the person, but very understandable. You can anticipate these things as an economist. We don't care about it. Structurally unemployed, huge problem. Okay, huge problem. And that means the factory worker simply can't get a high-tech engineering job. Why? Because they're an unemployed factory worker. The unemployed coal worker in West Virginia, where's that dude going to work? Right? Structurally unemployed, knows mining, doesn't speak Chinese. What are you going to do with this guy? Well, you're going to have to retrain him. Right? That's structurally unemployed. And that's a really, really bad thing. So we can have an increase in frictional unemployment, which means people re-entering the workforce, actively looking for jobs, and able to fulfill those open positions. That's good, so we can see an increase in frictional unemployment, which is only natural, the natural rate of unemployment. Unemployment numbers go up because they haven't got the job yet, but they're looking, but they're capable. Now, if we can get those guys jobs, now we have an increase in wages, which then translates to the marginal propensity to consume, which increases consumption, which then increases productivity, which then increases demand for jobs because of the increase in capacity utilization figures, which then drives all these other things, which continues to drive the C, and therefore factories start working at 100% capacity and utilization figures, which means then businesses need to invest into new equipment and into larger facilities, which then the I goes up. Right? Which means more taxes and more taxes and more taxes for the government. So the government's going to start spending and start building Donald Trump statues and all of a sudden, business spending or expenditures start going up, and all of this stuff leads to what? An increase in C, an increase in I, an increase in G, which then can have an impact on the value of the US dollar, which then impacts net exports, all of which equals GDP. And if you don't understand what I just talked about, you need to take the training course at FX Bootcamp. If that gets your juices flowing, it gets my juices flowing. Okay, we got 7 minutes, bro. What do you want to do? Seven minutes. Should we just cut it early? Cigar time? All right, well, Bitcoin thoughts? I don't really trade Bitcoin. I don't really know Bitcoin. I will be honest, I'm interested in mining it. Right? I have the ability to get electricity basically for free. So I've been told that that's the #1 expense. So I'm like, well, I can get that for free. I can do that cheaper than anybody else. And then I was reading or listening to a story about the founder of McAfee, that crazy guy, and he dropped like $2.5 million into a company that's going to build their rigs and plug them into a hydroelectric facility in Washington State. And it was like 2.5 million. Apparently that was a big investment. I'm like, 2.5 million was like, it makes those guys a player? I'm like, really? So it's a very, so I'm like, just out of interest, I might build a rig farm. Because I'd rather, in that case, I'd rather mine them than trade them, because it's just input output, right? So if I mine the Bitcoin, someone's going to buy them from me. It's 16,000 something today. And the basic calculations are like, if you're selling them at 800, you're turning a profit. So if I can just mine this stuff, and I have my input costs, which I can keep low, and I can sell it anytime I make a Bitcoin, I can sell it, right? Just like there's enough demand, I can't walk around the market. Hey, does anyone need this Bitcoin? Bitcoin's for sale, right? No, I mean, someone's going to buy it from me, right? So I'm like, oh, good. So I just need low, mine it, input, and then output is bigger than that. So you can literally break it down like this machine makes $5 an hour. So all I need is 1,000 machines. Then I make $5,000 an hour. Cool. I kind of like that, as long as you can scale it. So I could raise money. I can go raise 10 million bucks or something from a bunch of investors and just say, here's some land. It's really cheap. We can fill this warehouse full of rigs. It's going to take a lot of air conditioning, but I can get the electricity free. It's the actual power consumption is going to be a lot from all these processors. That's going to cost money, but I can get that super cheap. And here's the input cost. That's going to be a fixed cost. The upfront cost plus the variable expense of electricity. Okay, fine, but here's that model. That's what it's going to cost per hour to run, but not even based on 16,000, based on $1,000 per Bitcoin. This is how much we're going to earn. So it'll be $1,000 an hour, but it'll produce $5,000 an hour, which means we will make $4,000 an hour profit. And it will take this many days to get our $10 million back, and then after that, we'll split everything 50-50. Easy. And yes, I can get the electricity virtually free. Yep. So that's that thought. If you have the $10 million, let me know. We can set it up. I'm just busy. Sure, Ross, doesn't matter. By then we would have paid for everything, so it's just still free money. How does it? I don't know. It doesn't matter. I think it's like a year and a half or something crazy. Yeah, I would never. So when I thought about the guy, the McAfee guy, investing millions of dollars into a company to plug into a hydroelectric plant in Washington State, I'm like, first of all, the government's going to screw that up. And then, yeah, you're right. That's it. They're going to come in, screw it up, overregulate it. And then, you know, when I'm thinking of like the cost of electricity from this hydroelectric mine, and then I think of like, you know, environmentalists picketing the thing, Bitcoins are evil, you're funding drug dealers, and you're sucking energy out of this, and this should be going to poor people. How dare you make money? Making money is evil. You should be like Bill Gates and raping and pillaging technology and slowing the universe down by 20 years. Oh, wait. No, they don't say that. Maybe they should. But I could just see all kinds of problems of doing this in the United States. Right? You're going to get the EPA regulating you because you're plugged into a hydroelectric. You're going to get the feds on you for the financial institution, and then there's going to be some other tax and regulation and compliance and reporting, and I'm like, oh my God. So I'm going to do it somewhere else, of course. Yeah. And the orphans, Ryan. So I guess that's it, 10:30. So thank you very much, FX Street, for hosting me for the 141st time for Trade Non-Farm Payrolls Live. If you're an oldie that has been around dozens and dozens of times, I appreciate your loyalty and your respect that you show me every month. If you're new, swing on by tradersway.com, sign up for a demo account. It literally takes seconds. And every single day, Monday through Friday, I do hour and a half to 2 hour video or webinars just like this every single day. So as a client of Traders Way, you can attend those for free, and I'm happy to work with you every day. Like I said, technical, fundamental, trader psychology. I'm there every day. Just talk to me, Goose. So thank you, everybody. Really appreciate it. I really look forward to our time together. So it was only 3 hours. I don't know how many 3-hour webinars you get, but thank you for staying to the very end. I do appreciate that. If you need to reach me, it's Wayne at fxbootcamp.com. And what I'll do is I'm going to shut the video down, but I'll watch the chat for the next few minutes. So if you need to ask questions, or if you need my email address or something, just ask in the chat room, and I'm happy to help. So again, thank you for your time, and have a wonderful weekend. Peace on earth. May the pips be with you. May your profits be above average.